So let's say you're someone that has been looking to potentially deploy some saved up capital and invest it in commercial multifamily. And you've been reading maybe blogs or videos, somewhat like this, about investing passively, right? Because you're busy, you're making money, and you don't necessarily want to be the forefront person that's going out and buying deals. So if you're in those shoes and you're someone that's looking to deploy capital passively, one question you're probably asking yourself is, okay, if I have, let's say, 100 grand, what can I actually make on my money, right? Like, what are the real numbers? What do the typical numbers look like? What should I expect every year? So what I thought I would do is actually pencil out for you guys a pretty typical scenario of a syndication and show you guys how the math pencils if you're gonna be a passive investor and invest $100,000 in a deal. So I'm gonna map out those financials for you in this video, and we're gonna get after it right now. What's going on, guys? My name is Lior, and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out tons of new videos every single week, talking all about all different facets of multifamily. And number two, guys, if you guys are looking to potentially invest in multifamily, but you don't necessarily want to be that, lead person on a deal and do all that work, me and my team do multifamily deals all over the country. So if you guys are looking, to place your money, build out your passive income stream, build out your wealth, make sure you hit up the link below in the description, set up a call with me and my team, and we can see if working with us can be a right fit for you. So with that, let's get right into the meat and potatoes. And as I said, I actually right here have my notes in front of me. I penciled out a typical cash flow stream of what happens if you're a passive investor that is considering investing, let's say, $100,000 in a multifamily syndication. So let's set the stage a little bit before I actually show you how each year looks like. Let's say it's a typical 150, 200 unit kind of apartment complex with some value add strategy, right? So that means, the apartment building is doing pretty well, but, maybe rents aren't fully top dollar. Maybe there's some renovations that need to be done, some sort of stabilization work that's going to occur over the first 6, 12, and even 18, 24 months or so of ownership. So, you're going to be investing in that kind of deal. As a passive investor, you're going to have ownership in that kind of property. And what that will entail is you're going to receive cash flows from distributions every single year during your ownership. And then, of course, you're also going to get upside from when the deal sells, and you're going to get some of those profits as proceeds for yourself. So let's go right into it. So again, let's assume day one, you're investing $100,000. So let's start with year one, right? So in year one, a typical apartment syndication will probably pay you out somewhere in the vicinity of about, let's say, $5,500 or so over the first year, right? So that would mean you're getting a 5.5% cash on cash return, right? And that's probably a little bit lower because, year one, there's a lot of stabilization work going on, right? The team is busy doing renovations, renegotiating leases, and slowly kind of really trying to maximize that building over the first year. Now, it's year two. Let's say the team is starting to get rent bumps, right? So now you guys are actually starting to renegotiate a lot of these leases up. You've done some renovations, refilled up those units at top dollar rents. Now year two, you're gonna get $6,500 distributed to you, right? Which makes it a cash on cash return of about 6.5% for that year. Now let's go into year three. By this point, a lot of the stabilization plan has been executed on. Most of the rents at this point have been renegotiated, right? Most of them are producing top dollar. You've already deployed a lot of renovation money in your interiors, in your exterior. The property looks a lot better. So in year three, you're gonna get distributions totaling of about $8,500, right? Which is gonna be about 8.5% or so cash on cash. Now, we're gonna go right into it. Year four, again, rents are continuing to grow. Maybe you've stabilized your last couple of final units. And in year four, you're gonna get $9,000 distributed to you, or a 9% cash on cash return on your investment. So you've done pretty good, right? We started off about 5.5% cash on cash. As the years have worked up and we've continued to stabilize the property, we're pushing that cash on cash to 6.5%, 8%, 9%, so forth. So now what happens is it's year 5, and not only going to collect some cash flows, right, but we're also time to sell the property, right? We've achieved top dollar rents, we've executed the business plan, we've created equity for all the owners in the deal. So in addition to collecting your $9,500 of cash flow, right, which again is about 9.5% cash on cash, now the team is actually going to go ahead and sell the building. And when they sell the building, what's going to happen is, first, you're gonna get your equity returned to you, right? So you invested $100,000, you're gonna get that $100,000 back. And then, your share of the net proceeds from the sale will probably pencil out to about $85,000 or so, right? So you're gonna make $85,000 in additional proceeds from the sale of the building on your invested $100,000. So how does this all pencil out in terms of total deal metrics? So let's look at it from this way. Your average cash on cash during the hold period, right, before you sell, is about 7.8%, right? And that's really, really solid cash on cash, right? I mean, you're hitting almost 8% in a stabilized, in kind of a awesome apartment play. I mean, that is really, really solid. That is really, really solid yield. Now, your average annual return is penciling out to be about 24.8%, so just about 25%, which is huge, right? Now, look, obviously that average annual return is weighed heavily on your exit, right? Because a lot of your bulk of your proceeds are made on that year 5 sale, but still, your average annual return is almost 25%, on this kind of apartment play. And that's kind of the beauty that a lot of people don't realize is, even though your cash on cash is you typically kind of in the, low or mid teens or high teens, right? That average annual return, when you account for all the work that's been done, the improvements, the property, and again, assuming you bought a property in a good location that's still in demand of years later, you can actually see huge average annual returns on your investment. So that's fantastic. And then if you do your math on an IRR basis, that IRR pencils out to be just under 20%, so 19 and change, which is, again, also very, very solid, right? I mean, 19% is nothing to sneeze at. That's a very, very strong return. So you can kind of see how it pencils, right? You're gonna get those cash flows year 1 through 4. Again, probably somewhere in the vicinity 5-6%, ranging up all the way to 7-8-9%, depending on the deal. And then you're gonna have that big exit year 5 when you guys go and sell that building that you've worked so hard on stabilizing and getting top dollar rents and renovating. And that's where you're gonna make even additional proceeds. So you can see the beauty of this, right? You're making money every single year. And there's just, and this is, by the way, not including any tax benefits, right? So we didn't talk about depreciation or bonus depreciation and showing negative returns on your K1s. That's gonna be a video for another topic. This is all just pre-tax cash flow. So hopefully you can see the amazing power of investing in these kinds of syndications. And remember, this is also you being passive, so you're literally not doing anything, right? You're just cutting that check and you're letting the operators do the work. So hopefully this example is helpful for you guys. Of course, if you guys have any questions, make sure you put them in the comments below, or you can also, like I said, look at the link below, hit us up, set up a call with me and my team, and we can talk through the details with you guys as well. So hopefully that's helpful, guys. I will see you in the next video.